$13 per bushel of soybeans too far away to think of as COVID cases go higher in the US and oil demand drops. We are going to speak also about the wheat fundamentals and, of course, the sell and defend tactic with Michael Zuzolo, president of Global Commodity Analytics. He's an expert on all commodities. Right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. So, Mike, before we get into the soybean question, that will be a very interesting question on the $13. What do you think a weaker dollar that is the current trend with Joe Biden in the presidency of the United States? What that will mean for commodities in general?
Well, the weaker dollar would be good for commodities if it would continue, Luis. However, on the daily charts that I keep track of for the oscillators and the momentum, I'm actually starting to suggest to clients and subscribers that we may be getting a buy signal in the US dollar. And this has been starting to show up against the Brazilian real as well as the Chinese yuan in terms of them coming down and weakening some. And so we have seen a reversal of sorts in the currency markets where the dollar has started to change its recent pattern since the election. We don't know if this is going to hold on. We don't know if this is a true buy signal or whether this is a consolidation in the dollar until more is known about the election, until more is known about what you just referenced, the COVID spike. It's something that obviously has to be watched very carefully because I think with the post USDA report price action that we've seen in the grains, especially, I think this is part of the reason why we started to see some selling and some liquidation by longs has been this currency market kind of reversing and going against the commodity friendliness of that weaker dollar.
Well, you spoke before the Biden was elected. He's not yet certified, but is likely to be the next president of the United States. That probably China would buy more the coarse grain and soybeans from the United States if that happens. And do you think it's another factor, the weaker dollar? The Chinese can see that as another opportunity?
Well, I do think that you've hit upon something really crucial, regardless of who the president is. The weaker dollar and the stronger Chinese yuan and the South American weather have all worked very well together here the last 3 months. I mean, if you look at the prices of the soft red wheat futures since the end of June and the prices of the corn and beans futures since the middle of August, they've all gone up anywhere from 32 to 36% from their lows. And so this has in large part been just those three factors: the currencies, the Chinese demand, which is related to the currencies, and the South American weather problems, which is related to the Chinese demand. And so I think we're at a real inflection point right now, especially with the dollar looking stronger on some of these charts that I mentioned, and also with the weather models maybe starting to suggest a wetter and cooler pattern developing for South America, both Argentina and Brazil, as we get into the second half of November. And obviously, you and I both know that the really critical month is going to be December and January when it comes to actually making the production in the vast majority of South America. I think that's why USDA probably, while they lowered their soybean estimates for Argentina by 2.5 million tons, I believe, they kept their soybean estimate for Brazil unchanged at 133 million tons. And I think there's still some people out there like Conab that are up there at 135, 136. I can understand that, given that while it's increasingly important that the Brazil and Argentine pampas get rains, they're not completely dead in terms of being able to make an average to above average crop in a lot of those areas. So this is the dynamic we work in terms of a corrective wave in the commodities. And then what does the COVID spike do to us as well? And does that bring back the dollar as a safe haven? That's what happened last time. The dollar went higher when the COVID spiked because it was just as bad in Europe as it was in the United States. And the trade said, let's buy the dollar because it's the usual world currency and the usual safe haven. With the sell-off we've seen and the price we're at, why wouldn't they do that again?
When we talk about soybeans, or when we talk about South America, we talk about soybeans. So you think that it's too far away to think about $13 a bushel per soybean?
Yeah, I think what I'm alluding to right now with clients and subscribers is I'm not saying it won't happen, but I'm saying that it's unlikely to happen the month of November, and that we really need to stretch this weather market into the December and early January timeframe. Then we can really start knocking the production potential for Brazil from 133 down to 123. That's kind of what we've gotten used to when Brazil really has a weather problem, and that La Nina takes over in the Pampas region of Argentina and southern Brazil. Looks like center west and northern Brazil looks like they're going to continue to get some pretty decent rains, not be too hot for the foreseeable future, but that southern Brazil and Pampas region for Argentina continue to be the key. So I think $13 soybeans is unlikely, especially if the wheat market does not want to support the beans, because I think you're at that point again where you need the corn and the wheat to support the beans to get to that elevated price. I would look for that maybe more likely in January or February for that type of price action. And I went back and looked at the 2012 markets and what happened back during that time period. And while not everything is the same, obviously, we had 4 months higher, and then we cooled off for about a month, and then we had another 3 to 4 months higher after that, depending on what chart you look at. So I could see something similar, Luis, where we need to pull back a little bit, test support, check the demand market, make sure it's still healthy, see if South America gets rains. If all those things turn out to be price positive, then we should be able to take out the recent highs in soybeans. And then if we do that, there's really little resistance around, there's a little bit of resistance around $12, maybe quite a bit more around $12.40, but that's when you can start talking about $13 beans, I think.
And do you think that U.S. logistical bottlenecks with crushing can help to get to this number?
No, I think you're probably at a point. I'm under the assumption that major domestic crushers and global end users and global crushers, for that matter, have probably bought forward because of the pandemic and because of the Brazilian weather and the Russian weather and the U.S. hard red wheat weather. So I think you've got some purchases pushed out into the future. We've talked about that before. If I'm right about that, I think it'd actually be difficult for, if this COVID spike gets as bad as it could. I mean, the daily hospitalization number is now at a brand new high here in the United States. We've actually taken out the March and April highs of hospitalizations as of the 11th of November. They're now at 65,300 cases, people in the hospital due to COVID. So I'm really starting to get more nervous, as we've talked about not being able to manufacture, not being able to process meat and meat packing facilities going down, or shipping transport lanes going down, ships not being able to get offloaded with grains. These are the types of things I think we have to worry about because we had to deal with that last spring.
Indeed, we need a fast-track vaccine.
Yeah, and it doesn't look like that's likely. And that's one of the things that the livestock markets have been able to find a lot of support off equities and the new highs in the stock market here in the United States this week and late last week. But I think the reality setting in that a vaccine is not likely to be really widely distributed until April of this next year. And Luis, I just don't think that's enough. I don't think that's fast enough. I think you're 100% right.
Yes, and on the charts you are going to be seeing on the screen, we will see a real detachment from the U.S. wheat stocks from the world stocks. So, Mike, what do you think does that mean for the U.S. prices?
Well, I think the U.S. cash prices will still remain very, very strong because I think there is a battle going on between the classes of wheat right now because of these tight stocks. But I think in terms of the funds coming in and taking us up to that next level, this kind of goes back to the soybeans going to $13. I think you need wheat participating in that. And I just think, simply put, Luis, the stocks to use ratios globally for wheat are at a 30-year high now. We're well over 40% stocks to use and globally. And I think that's just too high of a number. Either the USDA is going to have to come down, or we're not going to be able to really accentuate the rally like I've been wanting it to when it comes to the funds coming in and buying more, because of the fact that wheat has been our leader. So you're I think going to see a situation develop where if it stays dry in the hard red wheat belt of the United States, but it doesn't stay dry in Russia, you'll probably see where the U.S. begins to once again price itself out of the export market, and that then in turn keeps the funds away from buying it. And so that's kind of the circular pattern that I could see develop here because of this U.S. versus global stocks number.
And what's the outlook you are seeing for the spring wheat?
The spring wheat, I think the weather pattern is getting better for the spring wheat. There's a little bit more precipitation getting up into the Canadian prairies and up into the North Dakota areas. I just did a media update with a podcast with a fellow from near Fargo, North Dakota, and they'd been getting pretty much nice, orderly precipitation flows, and I think they're replenishing, recharging moisture. So I think as long as the price holds up and the basis holds up, you'll see a good chunk of that Northern Plains area get a big acreage base build up again in spring wheat.
Yes, and are you seeing weather issues like the ones we saw in Russia and Ukraine as ones that could potentially worsen?
Yes, I think that is the heart of where I think the next wheat rally is going to be, because the world supplies and the USDA did take down the Ukrainian corn production. They took down, exports for Ukraine down 8 million tons. And we saw this week that the Russians went ahead and put in an import quota for the second half of their marketing year on wheat. But if we're going to see the funds come back in play on the long side of wheat, I think we're going to have to get the United States price reduced in reference to the Black Sea price. How do you do that? You see the Black Sea price go higher and the U.S. price stay relatively the same. Then I think that attracts more investor flows. And so that's where you hit it on the nose, in my opinion. If we're going to see a winter rally in the wheat market, other than the hard red wheat futures maybe gaining against the soft red wheat futures here in the United States, if we're going to see the investors really come in and buy, I think it's got to be because the Black Sea looks very threatened. Kind of like what we saw, I think, back in 2014. That was the last big rally in the Russian wheat because they had such a tough winter.
What's the number you are seeing in the near future for future prices of wheat?
Well, we're right on a major support level of 590 in the soft red wheat, and we just took out the major support level there, and also 535 in hard red wheat futures. These are lead month futures prices. With taking those out, if we would close out this current week below those levels, that would stimulate a sell signal, because we're actually in soft red wheat now down on the month. We're actually showing a red bar on the monthly chart, and we're breaking through a major trend line that's built off this 5 or 6 month rally we've seen. So if that opens that downside up, then we're looking at probably trying to go all the way back down towards the 545, maybe even 535 level in the soft red wheat. That's the major support level that we'd be looking at. Maybe we could find support around 560, but really 545, 535 area would be what I would see as really strong, rock solid support in the soft red wheat.
And to talk about the corn prices and the corn market, we have to get back to macroeconomics. So, Mike, do you think the energy markets will react by now as we have the election almost defined?
Yeah, I think between the election and the COVID spike, I think the corn market's going to feel the most pressure in the short term. In the futures market, I'm not sure the cash market will feel as much pressure, Luis. It really goes back to the ethanol break-evens. But right now, ethanol break-evens are remaining very positive here in the United States. We still are working off of a very low stocks level, roughly a 3-year low in the stocks level, and the production numbers starting to be rebuilt pretty nicely. So we're still using it, we're still blending it, and the profit per gallon is still running around 10 to 15 cents in most parts of the United States for where they crush ethanol. So I think the cash market is fairly well in solid footing at this point, especially with that 1.7 billion bushel carryover that USDA gave us. And I think USDA, like they oftentimes do, the actual carryover in corn is probably it's quite a bit lower than what they're projecting, because they always tend to lower that feed and residual number to make the carryover level not as low. That's my opinion. And so I could see where we're closer to a 1.5 or 1.6 carryover given this current demand base. We've got the export demand base, ethanol demand base, and this livestock demand base that is not going away anytime soon based upon the latest projections. We're going to have a large supply of hogs and cattle and poultry to feed here in the next 3 months. And this goes back to, if the corn market has weakness ahead of it, other than what the wheat market does, it's going to be showing through the livestock market. If the livestock market gets sick and goes down sharply, and we liquidate the herd or we drop dressed weights dramatically, then I start getting more worried about the corn and the corn that I have in the bin with clients.
Now, are you seeing any coming change for the USDA carryover?
Well, I don't know if they're going to change anything between now and January because of that big yield cut and the fact that they did increase the exports so dramatically. That surprised me. I was ready for the yield cut, but I was not ready for that big of a change in the exports. I thought they'd be a little bit more staggered on how they did that. But I think that is we talked about a 14.5 billion bushel corn crop. We talked about previously that the USDA had taken soybean production here in the US down to below 2018 levels, but they hadn't done that in the corn. Well, they did do that this week. And so that all matches up with me. So I think the trade has a pretty close understanding of where we're at on ending stocks. And that would suggest to me that we should have an acreage battle this spring coming up, depending on how bad the COVID becomes and what happens with the demand. But if the demand holds in there, I think the corn and beans are going to have to fight each other for acres. And therefore, I think the corn maybe doesn't have much more than another 20 or 25 cents downside. We've already eroded about 30 cents from the highs in the futures market just put out this week. So they've quickly calmed down, and the funds have taken quite a bit of money off the table already, I think.
And what's your marketing strategy right now?
Well, you had brought it up in the beginning of the program, the sell and defend model. Producers right now are tending to get more bullish. They're thinking these $13 bean levels for prices are likely, and $5 corn level prices are likely. That usually scares me. And so whenever I see that, and then I see something like COVID, and I see what's going on with our election and the currencies and all these potential black swans out there, I really want to take that unlimited risk out of the bin, because if you have corn in the bin, you're in unlimited risk between both the basis and the futures market. So I would rather you price that corn and go ahead and just buy back with the bought call. Or if you really want to hold the corn because you're in a bad basis area and you really think it's gone higher, then get those puts bought and get a floor underneath you.
So that's it for this edition. Thank you, Mike.
Thanks, Luis. Have a good week.